is something that is absolutely crucial to understand because, as we know, if SARS raises an assessment after an audit, you can bet your bottom dollar there's going to be an understatement penalty 99% of the time. And so if there are changes to this regime, we need to understand what it is. And it is quite a significant change in the sense that it's going to take longer to resolve the issue, in my view, but I don't think it's going to necessarily change the outcome. Right, so for those who don't know me, I'm Snikutron. I'm the Managing Director of Unicus Tax. Disclaimer, as per usual, this training is intended for my staff. For those of you joining online, it's for your interest's sake only. All right, so guys, what was the issue? First, before we understand what changed, we just need to recap again what was the position before the 1st of April, because there's a bunch of case law on understatement penalties, in particular on bona fide inadvertent error, right? And that's what this amendment relates to, is where bona fide inadvertent error fits into the bigger scheme of the understatement penalty regime. And we need to see what the case law, just refresh our memories what that is and see if that's still valid jurisprudence following the amendment. So first, the position before. And I think most of the guys online and most of you here will know the position that before the amendment, there could only have been an understatement penalty if the understatement did not result from a bona fide inadvertent error, right? So bona fide inadvertent error was a gateway or a gateway exclusion. It was the gatekeeper. It was at the threshold. If you could show bona fide inadvertent error, the rest of the USP regime becomes completely irrelevant. Right? What the behavior is, all those things becomes entirely irrelevant. So in practice, if you could establish bona fide inadvertent error, you escape the penalty altogether. Right? That was the position before the amendment. Before the amendment, we also had this remittance ground, right, in section 223 for the penalty. So that's assuming it wasn't a bona fide inadvertent error, right? So you got away, or you didn't pass, or I say pass, you didn't get away with bona fide inadvertent error, then you could still have a remittance of certain understatement penalties for substantial understatements if you had an opinion, right? But only if it was a substantial understatement. And this is something that is important to understand. This didn't change on the 1st of April, but there's still a common misconception about that understatement penalty table and how it actually works, right? Because there's a behavior column, and in that behavior column, we have intentional tax evasion, gross negligence, reasonable care not taken, etc., etc. And then right at the top, we've got one that says substantial understatement. That is not actually a behavior. It's a defined term that says the prejudice to SARS or fiscus is the high of 5% or 1 million rand, that definition. It is a default category that the legislator has said this default category applies regardless of how well you behaved, taxpayer. If you made a mistake and the prejudice to the fiscus is big, you must suffer a penalty regardless of whether you acted in the best possible intention possible. You must get a penalty regardless. But then we had the remittance ground to say, okay, yes, but if it is a substantial understatement, so in other words, the taxpayer isn't guilty of any of the behaviors, but there is a substantial understatement, but you had an opinion before the return was due and all the facts were disclosed, then SARS must remit the penalty, right? That was how the regime worked beforehand. So we had bona fide inadvertent error as a gatekeeper to the system. If you get past that, then you have to go through the behavior classification, right? If you skip all the behaviors, or you can defend your position against all the behaviors, and the prejudice to the fiscus is large, so that it's a substantial understatement, then it will stand unless you had an opinion from a registered tax practitioner and before the return was due, then you could get remittance, right? That was the position before. So there's two important judgments on the penalty regime before the amendment of the 1st of April, which is crucial and I think still holds today, and that's why I'm discussing them, right? So Coronation and Thistle are the two cases. So Coronation, the USP issue was decided in the SCA, whereas in Thistle it was kind of decided in the Constitutional Court. But the issue is in Coronation was that they had an opinion, or they said they had an opinion, right? SARS obviously, if I remember the facts correctly, it was a CFC issue, right? And whether certain amounts from the CFC should be imputed. And they got advice that said, no, it doesn't have to be because it qualifies for the foreign business establishment exemption, etc., right? And SARS said, no, you don't qualify for the exemption, so we're going to impute the money, we're going to impose a tax, we're going to impose an understatement penalty. And they said, but we had an opinion, or we had advice, let's put it that way. We had advice that said that we don't have to impute this income from our Irish company, because I think it was in the UK and Ireland or somewhere, I can't remember, right? And they failed to prepare or to produce this opinion that they relied on. They never actually came up with the opinion. And SARS kind of argued that, look, the court must draw a negative inference from the fact that, why are you not disclosing the opinion? That the opinion perhaps exactly say that you don't qualify for the exemption and you went contrary to it, because if that's the case, it's not a bona fide inadvertent error. But the court said, no, look, I mean, on the facts of it, the behavior of the taxpayer is such that there shouldn't be a penalty and it should be a bona fide inadvertent error, without deciding the meaning of the words, right? That's important. In Thistle, the issue was also the taxpayer had an opinion, and the issue was whether you could have, the substantive issue was whether you could vest income through multiple trusts, whether you can have the conduit principle apply through multiple trusts. And they had an opinion that said you can, and the opinion, quite interestingly, said actually that SARS holds a different view. And interestingly, one of SARS's arguments was because the taxpayer knew SARS had a different view, and because they didn't take SARS's view, the taxpayer must be penalized more harshly. The court swiftly dealt with that, right? Said, no, that's not, that assumes that SARS is the only one that has a valid opinion. They seem to think sometimes that that's the case, where often that's not the case, right? So anyway, but what is important in Thistle, and here's the crux of the matter, is bona fide inadvertent error was aggressively argued in the papers, right? In Thistle and in Coronation. In Coronation, the court didn't have to decide, the Constitutional Court didn't have to decide the issue, because Coronation won on the substantive issue, so the penalty fell away by operation of law because the taxpayer didn't make an understatement. Whereas in Thistle, the court engaged with this issue of the penalty and said, look, I'm not going to entertain SARS's argument on bona fide inadvertent error, because what SARS was saying and arguing, when you look at the submissions, you go to the Constitutional Court's website, you can actually go and read SARS's submissions, right, in both Coronation and Thistle. What SARS was saying is we can't have bona fide inadvertent error as a gatekeeper to the penalty regime. That's not how the legislation is intended to read, right? And also, the taxpayer here in Thistle actively or consciously adopted the position that you can apply the conduit principle, so there's nothing inadvertent about the position they took. So it can't be a bona fide inadvertent error. And the court says, well, I hear you, but it's not necessary for me to actually decide whether or not this case, or whether the understatement in the Thistle case was a bona fide inadvertent error or not. And he said, because the taxpayer relied on advice, the taxpayer cannot be guilty of any of the behaviors in the understatement penalty. So it's not, the court didn't decide in Thistle what is a bona fide inadvertent error. He said, well, the guys had advice. SARS, your position was, because they argued two grounds because they carry the burden of proof, and this is crucial, right? They said in Thistle that the taxpayer had no reasonable grounds for the tax position, alternatively reasonable care wasn't taken in completing a return. And the court in Thistle, the Constitutional Court said, well, you can't defend that. The guys had advice. That behavior classification you can't defend. Your issue, SARS, about the meaning of bona fide inadvertent error aside, right? I can understand, because I think the court does say there's multiple interpretations to this term, right? There could be SARS's and there's the taxpayers, but I don't have to decide that issue, because when I measure the behavior or the culpability of the taxpayer in light of an opinion, he's not guilty, or they are not guilty of any of these behaviors. So Coronation and Thistle kind of does the same thing, more Thistle, I think, than Coronation, where the court says, okay, it was heavily argued, the bona fide inadvertent error thing, but neither one was actually decided on bona fide inadvertent error. Thistle effectively said, well, you're not guilty of any of the behaviors, right? And so the court said SARS's case will fail, right? So what did they do after the 1st of April? Now, this is typical of SARS and Treasury. If they keep on losing in court, they just change the law, right? That's just what it is, right? So what they did is, with effect from the 1st of April, which is the date of promulgation of the Tax Administration Laws Amendment Act, is they say, I'm going to remove, or they removed, bona fide inadvertent error as a gatekeeper, right? They said, it's not going to be a gatekeeper anymore. Whether or not the taxpayer's understatement results from a bona fide inadvertent error is no longer the threshold inquiry. The threshold inquiry now is what behavior is the taxpayer guilty of, right? So they said, now we have to go in and impose the penalty and look at what behavior the taxpayer is guilty of, regardless of whether you think it's a bona fide inadvertent error. And this is what SARS was trying. If you look at the arguments in Coronation and Thistle, they had two main arguments on bona fide inadvertent error. If you really look at the substance of the arguments, at least how I interpret it, they said, look, we cannot have bona fide inadvertent error as the threshold inquiry. That's not what the legislator intended, because the legislator, the argument, if I remember correctly, went something along the lines of, when you look at the section, it says SARS must impose the highest applicable penalty, right, for the behavior. So anyway, so the one arm was you can't have bona fide inadvertent error as a gatekeeper. That was not the intention of the legislator. That's not how it must be read. And the other arm of the argument for SARS was you must determine whether or not this requirement is satisfied based on whether or not the position was inadvertent. If you consciously adopt the tax position, it cannot be inadvertent, right? All this amendment does is it addresses the one arm of the argument, because it removes bona fide inadvertent error as a gatekeeper. You can no longer avoid the imposition of a penalty by simply saying it's a bona fide inadvertent error. They moved it and they linked it to substantial understatement, right? So, and before I go on to this, so how it works now is if you want to dispute an understatement penalty, you cannot raise bona fide inadvertent error if you have not defeated all the other behavior classifications. Because now you can get a remittance of an understatement penalty only for substantial understatements if it's a bona fide inadvertent error, right? So before we had bona fide inadvertent error as a gatekeeper to the penalty regime altogether. Now it is a remittance ground only in the residual substantial understatement category cases. So if SARS does an audit and they make an adjustment and they say, and they can defend it because they carry the burden of proof, they say this is reasonable care not taken in completing return, you can argue bona fide inadvertent error until the cows come home. It doesn't matter. If they prove reasonable care not taken in completing return, end of discussion. You now have to effectively, as a taxpayer, you're going to have to defend the behavior classification that SARS is holding you guilty of so that it can default to substantial understatement if it is a substantial understatement, and then only can you rely on bona fide inadvertent error. Right, so now that's what they did, right? So it makes it harder to get to the same answer. And some people might say, but hang on, does that now mean if we have a case where we're not guilty of any of the behaviors, but it's not a substantial understatement, does that mean I don't get the benefit of bona fide inadvertent error? No, but you don't need it, because then there won't be a penalty, right? Remember, if you go and you defend your case on the basis that the taxpayer isn't guilty of any of the behaviors, right, and it's not a substantial understatement, well, then there can't be a penalty. It's only if there is still a substantial understatement, despite you not being guilty, then you go back to bona fide inadvertent error and try and argue remittance. So the point is you're going to have to fend off this behavior classification before you can get to bona fide inadvertent error. It's going to be, in my experience, long-haul litigation to get there, right? It's not going to be, oh, I'll just raise bona fide inadvertent error, I took some advice. Those days are gone, right? Now the question is back to Coronation and Thistle, especially Thistle. Would the outcome have been different, right, if this amendment was, or if the law read like this at the time those understatements happened? And I think the answer is no, I don't think the outcome would have been different. In the case of professional advice cases where you've got an opinion. Because ultimately, SARS still carries the burden of proving that you're guilty of one of those behaviors. And if you've got an opinion on which you bona fide relied, because believe you me, there are people who go opinion shopping, right? Because one person will say X is how I don't like that answer, let's go to person B. And eventually we get an answer we like and we'll rely on that. That's not bona fide reliance on advice. That's stupidity, right? That's not going to get you across the line from a penalty, right? So, but in proper professional advice cases, properly substantiated opinions, because you also get some opinions, I've read some of them, you go, this guy's opinion, it looks like his personal opinion, not a professional opinion, right? So it has to be a proper advice, and then you can say, well, I'm not guilty of any of the behaviors. So you're still going to get the opinion to argue that. But now the issue for me, so I don't think Thistle or Coronation would have been different, right? I think that if you still can show that you acted with reasonable care and you weren't grossly negligent, you had proper advice, then the fight will be had, not on the basis of it being a bona fide an error, on the basis I deny any of those allegations of behavior classifications. And this is important because SARS is ultimately still the one who needs to prove their case, right? So, like I said before, if SARS, or it's typical if they lose, often they tend to change the law. If they lose something big, they tend to change the law. And so this all this amendment really does is it shifts the inquiry from threshold inquiry to remittance ground, and in very narrow circumstances. So it has really limited the circumstances on which taxpayer can rely. Is it going to substantially change necessarily the outcome of disputes? No, I think it's going to take longer to get to the result, because you're going to have to fend off these behavior classifications. And then the other thing that this amendment does not do, right? It still does not define. I just want to see, sometimes I despise slides, right? What the amendment does not do is it doesn't change the meaning, or it doesn't tell us what the meaning is of bona fide and advertent error. You remember I said in Thistle and Coronation there were two major arms. The one is it should not be a gatekeeper. The other one is what does it mean, right? All this amendment does is it changes it's not a gatekeeper. It still doesn't answer the question of what does it mean. So you can imagine this fight now, right? It's going to happen. SARS is going to impose an understatement penalty. They're going to go, as they tend to go, gross negligence, because all taxpayers are supposed to know the law. Right? There are exceptions where they don't go gross negligence, but they impose a penalty. You now have to fend that off, right? And what SARS is going to start doing, because they have to, because in Purdish the court told them that you must do this, you must argue. If you want to argue for different penalties, then you must argue and support it with the facts. So now what's going to happen most likely is SARS is going to argue it's that, alternatively it's that, alternatively it's that, alternatively it's that. Right? So you're going to have to fend off each one of those behavior classifications. And if it's not a substantial understatement, you get out. Right? You're off the hook. If it's a substantial understatement, your inquiry goes another step further. Is it a bona fide inadvertent error? What does that mean? Right? Do you see how this becomes protracted, very protracted dispute resolution on understatement penalties? Very possible. I'll talk about something in the USPs in a minute, but it's very possible, but it becomes protracted. So, look, I mean, at the end of the day, I don't think the outcome is necessarily going to be materially different to the answer. It's going to take longer to get there. But it's unfortunate that you still have this issue where even if you could defend or fend off SARS's assessment on all those behaviors, and it's a substantial understatement, and then either you have an opinion beforehand, right, on full disclosure that says your case will be upheld if it goes to court, or it's a bona fide inadvertent error. What does that mean? My practical takeaway on this is because we still don't know what bona fide inadvertent error is, and as much as I don't like to admit it, I have to, because the court in Thistle said there's merit to the SARS's interpretation. It seems like it could make sense, right? I have to say, unfortunately. So you don't want to be in the position where now we have to go and quabble. So we've defeated this whole behavior classification thing. Now we have to go quabble about the meaning of bona fide inadvertent error. I mean, it's like it's a never-ending dispute. So in my mind, the best practical takeaway of this, I think for a client is get the opinion from a registered tax practitioner before the return is due, because then you qualify for remittance. We don't have to worry about whether it's a bona fide inadvertent error. Also, it's going to help you fend off the behavior classifications anyway. So you're going to end up with the Thistle defense anyway. And in addition to that, you'll have the remittance ground if it then defaults to substantial understatement. But the last thing you want to do is want to be in a position where you have no advice in writing. You have to go and fend off all these behavior classifications. Then if it's a substantial understatement, then fight with SARS about the meaning of the words bona fide and inadvertent error, because there are two meanings, right? There's the one that the tax court gave to it before this amendment, but doesn't really change what the court said. It said a bona fide and inadvertent error is an innocent misstatement without the intention to deceive, right? And there's some case law that supports that interpretation. SARS says no, that's not what it means. It means a honestly unintentional mistake. So the substance or the argument or the focus of the bona fides must be on the inadvertentness of the error, not of the error, right? So it must be truly inadvertent. And so you're going to end up, if you don't have the advice, you're going to end up with understatement penalty cases where you're going to have that fight with SARS as well. And it seems like it's a fight that's going to go all the way to the Constitutional Court, because SARS is not budging on what it means, right? And there are counter arguments from lower courts, granted, but there's no superior court judgment on the meaning of bona fide and inadvertent error. So you're going to end up with this issue anyway. So the best way to deal with this is to get the advice proactively. That's the most practical way of dealing with this amendment, because in the past you could kind of fall on the back door of bona fide and inadvertent error. I had advice my accountant told me, or my accountant sent me an email. That's not necessarily formal written opinion, but it's advice. And that's what taxpayers use to say, well, as a gatekeeper, then I'm out. That no longer flies, right? So you need formal written advice on the particular issue if you want to be in the best possible position to defend. Because tax law is complicated. I mean, we see this every day. You're going to end up with mistakes, and you're going to end, and SARS is going to impose a penalty if you make a mistake. They don't care. And in their defense, they don't have to care. The legislation says they must impose the penalty. It's not like they have a choice, right? So if you want to be in a position where you can fend off any potential mistakes, if there's something in a tax return that you're filing that you go, you know, that's a bit greyish, I'm not quite sure, get professional written opinions on full disclosure before that return is due, because that will fend off if it turns out you're wrong. And contrary to popular belief, tax law is not simple. And people often, I think inadvertently, take positions in tax returns, quite aggressive positions, without knowing it's an aggressive position. They don't know. They speak to the accountant says, yeah, man, that's definitely a zero-rated sale. It's not a problem. Clearly, or no, that's an exempt transaction. You don't have to worry about that. That's fine. And then taxpayers go, yeah, well, my accountant said so, so it must be true. And they work on the back of that, and it turns out they're wrong, right? And the taxpayer gets the penalty, and they want to say, but I asked my accountant. And the court's going to say, well, who cares? Right? Unless you've got a formal written opinion, and unless we can go with bona fide inadvertent error being an unintentional mistake, right, then you're going to end up in trouble. Because the fact that your accountant said something doesn't mean you had reasonable care or you have reasonable grounds for the tax position you've taken. You know, I've had people say to me, my accountant said this. I said, but did you not question? Yeah, I thought it was a bit odd, but whatever. I said, well, that's a problem. That's a problem because you should question the advice. And you should make sure that the positions you take are defendable, because it is not simple. It's not the case. We work in dispute resolution every day. We see every day where SARS reverses things. It's not as if in the past it was different, right? In the past, SARS wasn't as aggressive. And so it seemed like they would let things slide, whereas nowadays they just don't, right? They look for reasons because they're under pressure to collect. And so while things in the past were smooth sailing and the penalties were few and far in between, although we still saw a lot of them, I think it's just going to get more and more and more, right? And this is going to empower them more and more and more to impose the penalties. And so we're just going to see more of them. Right, so let's pause here, and then I'll take questions. And then what I thought I'll do, I think more for the guys who's joining online, is I wanted to put in a segment in the session, not long, just an example of a case we're dealing with, kind of war stories, because it's interesting and it's nice to know when we win SARS, right, which is always, but it's nice to talk about it. So let me see, are there any questions from the guys in the office in the boardroom? And you saw the article that I wrote on this. Okay, so you've read it. So what I've said now is boring you to death because you read the article. All right, fair enough. So for those of you who don't know, there is a detailed article. Let's see in the questions section here who has questions. Please, you're welcome to raise your hand and unmute yourself and ask the question, or you can type your questions in the Q&A box here. So let's see. Yeah, Marika says, if it's a bona fide inadvertent error during VDP but not substantial, how does that? You see, the problem with VDP is when you look at the requirements for a valid VDP, Marika, it says that the default must result from a behavior as listed in the understatement penalty percentage table. So if you enter into VDP and it's a substantial understatement, it's still a behavior in the understatement penalty table. So you should get, I mean, we've done many VDPs where the behavior classification we said is substantial understatement, right? And so you should qualify, Marika, it shouldn't stop you from qualifying for VDP. So I think, you know, it may be, because there was a time, and that's why they changed section 226. There was a time when the VDP legislation read, the taxpayer, the default must result in the imposition by SARS of an understatement penalty for you to qualify for VDP, right? And then there was let me say my unofficial, I heard, unofficial stance from the VDP and say, but if the default, because tax would say it's a bona fide inadvertent error, then they say, but you can't, then I can't impose a penalty, so you don't qualify for VDP. If we caught it outside you saying it's a bona fide inadvertent error, we wouldn't have been able to impose a USP, so you can't qualify for VDP. And then they changed section 226 to say, no, it must simply involve one of the behaviors listed in the understatement penalty percentage table. So not that it must necessarily result in the imposition of an understatement penalty. And that was fairly clear from the EM, although some people have very strange interpretations, and I won't say which unit, but it rhymes with Smitty P. Right. If a taxpayer submitted an understatement but paid sufficient provisional tax, can they still levy an understatement penalty? Well, no, because, and this is something that's important, is when you look at the understatement penalty regime, these are very difficult to defend, right? And people tend to typically go in, now it's going to change slightly, but they typically go in bona fide, inadvertent error, etc., etc. But one of the things you must look at is, are all the requirements satisfied? Because I've won I've won USP cases simply on the basis to explain to SARS there's no shortfall, right? Because when you look at the legal requirements for the imposition of understatement penalties, there must be a prejudice to SARS or the fiscus as a result of an incorrect statement in a return or an omission from a return, etc., etc., right? Then, well, now the understatement is gone. Now, then there must be a shortfall, and there's only 3 types of shortfalls catered for in the legislation. There's only 3, I think, possible in reality. There's 3 types of shortfalls. In this case, Marika say the shortfall will be the difference between the tax properly chargeable and the tax chargeable if the understatement were accepted, right? That's your shortfall. In your case, it seems there is no shortfall because the taxes was paid, unless, I suppose, if they originally filed the return, you overpaid because there wasn't an understatement. It creates a refund, and then they reverse that, right? Does that make sense? So, if you paid sufficient provisional tax to cover an understatement, then on your original submission you would have been assessed to a refund, because it means you overpaid provisional tax. If they then reverse it, they'll still impose an understatement penalty, and I think they can, because there's one of the shortfalls is the difference between the amount properly refundable and the amount that would be refundable if the understatement were accepted. So, and that's paragraph 2233B, I think it is the section that talks about the refund shortfall. So yes, I think they can. But the point I wanted to make earlier is when you are defending an understatement penalty, you look at all the legal requirements, you have to see if you can take it out on any one of those. Right? Is there prejudice? That's fairly wide now following the Purdy's judgment, but is there prejudice to SARS or the fiscus? Is the shortfall there? Because we've won cases to say to SARS there's no shortfall, right? Especially on assessed losses, where they want to say, because there is a provision that allows for assessed losses, but then I've made successful arguments to say there's not a shortfall. And then on the behavior classification, one has to be very careful with that, because SARS carries the burden of proof, right? And I have, in many cases before, looked at SARS's grounds for the understatement penalty and said, you know what, I'm not going to say anything, I'm going to say you are put to proof, right? SARS, because good luck, because the nonsense that doesn't support gross negligence, not even close. And if you're going to add something later, I'll add it as an ovation, I'll have it struck, and then you have no case on the understatement penalty. So there's different ways and angles to defend it. Tracy says, what if you are in a dispute process already and have used bona fide as a ground? This will now fall away as the dispute is unresolved. No, you can still pursue it. Marika, I'll get back to you now. You can still pursue it because the question was, what was the regime at the time the assessment was raised? Not now. It doesn't change the position in existing matters already. So no, you can still proceed with your bona fide inadvertent error argument if the assessment was raised before the 1st of April, 2026. Marika, your hand is raised. Go ahead.
Hi, Nico.
Right.
I want to know, let's say the taxpayer submitted the IT return as a 0 return. But provisional tax, let's say, paid 3 million rand. Then, when the final calculations was due or done, it was, say, payable 4 million rand. So the prejudice, I would say, is 1 million rand.
Yeah, depends. Because remember, if they filed a null return, and this is effectively the facts in Polish holdings, is what happened, is the taxpayer filed a null return, but they paid provisional tax. And one of the arguments that was raised by Mr. Gehring, I won't mention his exact name, but one of the arguments that was raised by Mr. Gehring was there's no prejudice to SARS, or the prejudice, exactly the point you're raising, Marika, is only 1 million, because all the money was paid in provisional tax, right? Or 3 million of the 4, in your example, was paid in provisional tax. There, the argument was everything was paid in provisional tax. And the court said, no, that's not, any prejudice to SARS means any prejudice. So not necessarily only monetary prejudice, right? And the court said there in Polish, it said, The fact that SARS had to go and check whether your null return was correct or not is resource allocation and opportunity cost. That's a prejudice. The following thing the court to SARS, the following thing the court said the prejudice can also be to the fiscus to qualify as a prejudice. And here the prejudice to the fiscus was the money was sitting on the provisional tax account and could not be used in the budgetary process because it was sitting on provisional tax. So there's prejudice to both SARS and the fiscus. So the question, Marika, is not, unfortunately, for understatement penalties, what the monetary prejudice is. We ask the question, is there prejudice to SARS of any way, shape or form? If so, then we go ahead. The next question then is, fine, what is the shortfall in Marika's example, right, of the 3 and the 4? The shortfall is still going to be 3 million because the original return went in as a null. Provisional tax would have been consolidated to the ITA 34 and it would have kicked out a refund or would have shown a refund of 3 million. When SARS then adjusts it, it'll show that the refund is actually null and there's R1 million payable. So your shortfall will be 4 million rand. You'll have a paragraph B shortfall, the difference in the refund, and a paragraph A shortfall, the difference in the tax. So your shortfall will be 4 million and they can impose a 50 or 25 or 75 or whatever percentage penalty is on the 4 million. And the argument, although I understand your logic, but the argument about it's only R1 million prejudice will get you nowhere. It's going to lose because of Polish. It's as frustrating as counterintuitive as that seems. It won't fly.
Okay, thank you.
And your pleasure. Right, any other questions or comments? Marika, I take it that's an old hand. If you could just drop your hand. All right, so guys, just quickly, and I think, like I said, I want to share some more stories, but if you guys aren't interested, that's fine. The guys online, but we often see interesting cases, and when we get them resolved, it's nice to talk about them and reflect on them. We had a case recently, it was an individual taxpayer, and this person came to us, they'd already, and Busi must help me, they'd already went to someone who did their objection. So, and this person was rendering services, and I don't want to say what type of services because then I might disclose the taxpayer, right? But this person was rendering services offshore, and the issue was there was certain income that was overstated in the original assessment, and the exemption, I think the 10102 exemption was it? Was it 10102, the foreign services? Oh, cruise ships. Okay, are you sure? I'm talking about the same taxpayer. Well, there was another one that was a 10102. But anyway, this, yeah. So I'm talking about the 10102, not the cruise ship one. Okay, so they had gone to someone and somebody objected, and then, but they didn't in the objection. They didn't put the exemption in the objection in the NOO. They raised it in the supporting documents, but they didn't put it in the NOO. They only put the income in there. And SARS issued an outcome of objection and said objection allowed. Yet the assessment was never issued to give effect to the objection, right, at all. I think not even the income part of it, Busi, was given effect to, right? And so the question then was and that's when the client came to us and said, what must I do now? Because I didn't put the exemption in the objection. I put it in my papers. I put the income in, and SARS said they allowed it, but then there's no assessment. What now? What's the process to follow? And ultimately we said, well, the process to follow is not a tax court process because this is a decision by SARS not to give effect to 93(1)A. Because section 93(1)A of the TIA says if you resolve a dispute, SARS must issue a reduced assessment to give effect to that. And so we said, well, you're not doing that, and that decision not to do that is not subject to objection and appeal, which invokes the jurisdiction of the High Court, which means if we want to institute action, which means we have to serve 11-4 notice, and we served an 11-4 notice on SARS, right? And it was 2 days, and SARS issued the reduced assessment, say, sorry, we'll allow the foreign exemption, and we'll fix the income. 2 days, right? They'd been struggling for months on end to get this resolved. Also, there was a bit of a grey area on the exemption, because the exemption, it becomes debatable. Look, it's been allowed, so I'm happy that it's been allowed, but there was a grey area on the issue of the exemption when SARS issued that letter to say objection allowed, but the exemption wasn't on the NOO form. It was in the supporting documents clearly placed under objection, but on the NOO form it wasn't. And so the question is, when SARS allowed that objection, did they allow the exemption, or did they not allow, did they just allow the income, which was specifically on the NOO form, right? And we took the position that, well, look, I mean, if you actually read the supporting documents, which you must, because that's your job, then you cannot try and argue that you did, and that's part of the reason we went 11-4, is if they wanted to say, no, we didn't put it under objection, said, did you read my papers? So no, so one basis that you then allow the objection on the other things because the only grounds are set out there. And so are you saying you just decide what to allow and what not, right? And that's a strategy as well. So that's the case we got across the line. It was not entirely clear cut, but you can sometimes force them into a corner where they don't have a choice but to concede. Right, but that's strategy. All right, guys, any further questions or comments? Right, something else that's important from the Tax Administration Laws Amendment Act, which is not on the slides, which I just wanted to touch on, is suspension of payment applications. You know that in the case of estimated assessments that SARS raised in the 95.1A and B, before you 95.1A and 95.1C, you cannot object. You have to first submit the return or submit the relevant material before you're allowed to object, right? And then SARS, because SARS must go and do their audit work first. Before the 1st of April, technically there was a technical argument that you cannot do a suspension of payment in the time period where you're waiting for SARS to now look at the relevant material, to look at the return you filed, so they could take collection action. And the trouble is there's no prescribed time period within which SARS must look at that return or look at that relevant material before they make a decision whether they're going to change the assessment. So that was a gap period where SARS could take collection steps and you could do a suspension of payment, but technically in law it's debatable whether it's permissible because Section 164, which deals with suspension of payments, said if you intend to object to the assessment, then you can apply for suspension of payment. If you've got an assessment, a 95.1A or C assessment, you can't object to it. So the argument was you can't be intending to object to that assessment because it's not subject to objection. And so you can't do a suspension of payment. They did. I think you can argue it the other way around, right? I don't think that's necessarily the legal position, but for good measure, they changed the law with effect from the 1st of April to now specifically say in Section 164, if you are doing a reduced assessment request in terms of 95.6, in other words, you are submitting the relevant material or you're submitting the return, then you can apply for a suspension of payment application as well. So it's now specifically written into Section 164 that you can apply for suspension of payment if you're doing what is effectively a reduced assessment request under 93.1F read with 95.6.